Tuesday, July 25th, 2026. S&P 500 futures are up 0.5% this morning, edging near 75.21. Nasdaq futures are surging 1.2%, trading near 29,121.
But look at the options flow. The broader retail crowd sees a green screen and assumes the correction is over. Our institutional briefings are explicitly categorizing global sentiment today as strictly neutral and coiling.
Right. The smart money is not buying this early morning rally. If you only look at the surface level price action today and ignore the mechanics happening in the bond market, you're walking blind into a massive liquidity vacuum.
The real risk here is the macroeconomic tug of war, pulling capital in entirely opposite directions. I mean, you have to look at the geopolitical overlay driving the tape right now.
We've had 10 consecutive nights of U.S. military strikes in Iran. Analyzing this strictly for the market impact, that escalation built a massive war premium into the energy markets over the last week.
Yeah, but overnight, diplomatic back channels have opened. Brent crude oil has immediately retreated. It dipped back below $90 a barrel, hovering right around 88.33 this morning.
The pressure valve on energy is releasing slightly, but that slight release in the oil market is just a temporary mirage of safety.
Exactly. The dominant structural reality today is the Federal Reserve. We're currently in a mandatory blackout period ahead of next week's FOMC meeting. Fed officials are barred from speaking.
There is zero forward guidance coming from the central bank. But if the Fed is silent and the geopolitical war premium on oil is actually cooling off, shouldn't equities have a clear runway to push higher?
A vacuum of information does not equal a runway. In the absence of central bank rhetoric, algorithms and portfolio managers demand hard, fundamental proof to justify these current valuations.
Because oil eased slightly and the Fed is sidelined, the entire weight of the market has violently pivoted to Q2 earnings.
Right. Institutions are not trading the hope of future rate cuts today. They are stress testing whether the current corporate profit engine can mathematically support the incredibly high multiples in the technology sector.
Which brings us directly to the first major headwind creating the pain trade today. The bond market is telling a different story than the Nasdaq futures.
Look at the 10-year Treasury yield. It's stubbornly elevated, sitting at 4.59%. It barely dropped a single basis point from yesterday's close.
For anyone managing a portfolio, you have to treat that 10-year yield like gravity in a discounted cash flow model. When you value a mega-cap tech company, you discount those future cash flows back to today's dollars.
And the 10-year yield is your discount rate. At 4.59%, that gravitational pull is incredibly heavy. It forces the present value of those future earnings to compress.
Retail investors and a large portion of consensus analysts started this year heavily positioned for aggressive Fed rate cuts. They crowded into long-duration bonds.
They were trying to lock in yields before they theoretically dropped. But structural inflation remained sticky, and supply shocks kept commodity prices elevated. Yields did not drop.
They stayed pinned near multi-month highs, and mechanically, when yields stay high, the price of existing bonds plummets.
Which means retail investors who bought long-duration treasuries thinking they were buying a conservative life raft are now absorbing brutal capital losses. They are fundamentally trapped in those positions.
That forced capital destruction leads directly into equity positioning, and it triggers the second layer of the pain trade, the U.S. dollar index.
The DXY is holding near a one-week high. It's trading up around that 100.90 to 100.96 range. It's absorbing all the safe haven capital fleeing those Red Sea shipping risks.
A strong U.S. dollar is traditionally a sign of American economic resilience. But the institutional notes are flagging a 100.9 DXY as toxic for mega-cap tech.
Because the velocity of the dollar strengthening forces systemic deleveraging. Think about the pure mechanics of a multinational tech giant. A massive percentage of their revenue is generated overseas.
Right, in euros, yen, or pounds. So when the U.S. dollar spikes to that 100.9 level, foreign buyers effectively have to pay more for the exact same software.
But the real damage happens on the balance sheet. When those companies take their overseas revenue and translate it back into U.S. dollars for their Q2 earnings reports, the strong dollar severely dilutes that cash.
It literally erodes their profit margins without their underlying business operations changing a single bit.
Exactly. They're losing margins strictly on the currency conversion.
Yeah.
And when you were trading at 40 or 50 times forward earnings, you cannot afford a 3 or 4% arbitrary hit to your margins.
This creates a massive divergence on the tape today. Retail investors are stubbornly treating top-heavy tech stocks as a safe bunker. They're crowding into the same AI names.
because it worked for them last year. But institutional money sees the heavy gravity of a 4.59% bond yield and the earnings poison of a strong dollar.
So they are rotating. The smart money is quietly slipping out the back door of the tech bunker. They are deploying capital into counter-cyclical value stocks, energy, and hard assets.
The retail assumption is that the broader market is either going to break out or crash. The institutional reality is that the market is rotating.
If your portfolio is over-allocated to the wrong sector when a structural rotation accelerates, it functions identically to a crash for your personal net worth, even if the S&P 500 stays flat.
Before we track exactly where that institutional capital is flowing this morning, we have to define the structural environment of the tape itself. Our briefings explicitly warn that today is dominated by post-OPEX chop.
Options expiration cleared off the board last Friday. That event wiped out a massive amount of positional hedging by market makers.
And throughout this week, those dealers have to fundamentally rebuild and re-hedge their option books. Historically, this dynamic suppresses clear directional trends.
It creates artificial boundaries, trapping the indices in a volatile, range-bound pinball machine. It is designed to lure impatient capital into chasing false breakouts.
Yet even inside that localized shop, we have severe institutional repositioning happening in individual equities. Let's isolate the pre-market gappers.
Micron is surging nearly 6% this morning. They just reported fiscal Q3 revenue surpassing $41.46 billion.
The leadership at SK Hynix just hit the tape, confirming that AI memory demand remains abnormally high across the supply chain.
Morgan Stanley immediately issued a note calling this recent pullback a definitive entry point. They set a bull target of $1,268.93. Downside bear level is $804.
Semiconductors operate under a different set of physical rules than the rest of the technology sector right now. Micron is not trading on the vague promise of future software efficiency.
They are delivering verified, staggered revenue growth based on physical infrastructure spending. Institutional capital views AI hardware enablers as a dominant capital expenditure cycle.
The suppliers are confirming the physical demand exists today. That survives the gravity of high interest rates. But the rotation becomes undeniably obvious when we look at the non-tech movers.
Look at Danaher, a massive medical and life sciences conglomerate. They just released a Q2 beat. Revenue is up 5.5% to $6.3 billion.
Earnings per share up 8% at $1.94. They also executed the close of their Massimo acquisition ahead of schedule.
The institutional bull level is sitting around $217.42, targeting $242.52. The bear floor is anchored at the 50-day moving average near $189.21.
Institutions are demanding earnings quality today. Then look at global payments. Morgan Stanley upgraded them to overweight this morning.
They aggressively moved their price target from $65 all the way up to $100. Bull level is $100 with a blue sky target of $111. Bear level is $67, floor at $60.
Wall Street is pouring capital into that name specifically to reward their operational efficiency and aggressive share buybacks. They are returning capital directly to shareholders.
And finally, General Motors. Shares are currently trading at a forward PE ratio of under 6. The institutional flow is testing whether GM's premium SUV pricing power can counteract their slowing volume growth.
The shift in capital allocation here is ruthlessly pragmatic. Institutional money is refusing to pay premium multiples for technology companies that might deliver cash flow in 2028.
It's the ultimate defensive posture. A legacy automaker like GM is attracting smart money solely because a forward PE under 6 represents an undeniable value proposition.
When you only have to pay $6 for every dollar of future earnings, you have a massive margin of safety. Compare that to paying $50 for a software company facing currency dilution.
They are buying companies that generate real cash flow today to survive the macroeconomic gravity. You are seeing the architectural foundation of the market being rebuilt in real time.
So how do you actually execute in this environment? The institutional desks have drawn very specific lines in the sand for the indices today to prevent getting caught in the morning volatility.
Let's analyze the S&P 500 levels. The primary resistance is the pivot zone between 75.48 and 75.50.
The algorithmic buyers must reclaim that specific zone to fill Friday's technical gap and push toward the 75.77 target.
But the critical downside marker is support at 74.85. The briefings explicitly label this smash level, identifying it as a low-volume node.
That's completely erased if we break that level. If 74.85 fails, it exposes a rapid, uninhibited drop down to the 74.65 to 74.70 zone.
Looking at the Nasdaq, the upside resistance sits at 29,220. The ultimate bull trigger is higher, between 29,395 and 29,517.
But the downside support is a shelf sitting between 20,770 and 28,820.
Losing that shelf exposes a brutal drop to the macro floor at 28,408.
The real risk here is ignoring the mechanics of how these specific levels operate. A low-volume node, like that S&P smash level you just highlighted, is not a suggestion. It is a literal void in the historical order book.
We need to break down the mechanics of that void. To a retail investor looking at a candlestick chart, a hyper-specific warning about 74.85 sounds like noise.
Because the market does not move smoothly. It moves from liquidity pool to liquidity pool. Imagine the order book as a mountain. A high-volume node is solid rock.
Meaning a massive amount of historical trading has taken place at that specific price point. There are thousands of institutional bids and asks stacked up there.
Right. If the market drops into solid rock, those orders absorb the selling pressure and the price stabilizes. But a low-volume node is a hollow cave inside that mountain.
Very little historical trading has ever occurred at that price. There are no resting limit orders waiting to buy.
If the market price breaks the crust and falls into that low-volume node, there is nothing there to catch it. The algorithms immediately pull their defensive liquidity.
And the price literally free falls through the empty space until it hits the floor of the cave, which in the S&P data today is roughly 20 points lower.
It's an algorithmic trapdoor. It is simply a mathematical gap in historical liquidity. That structural reality is why the ultimate institutional directive across all our briefings today is identical.
Exercise extreme patience. Do not chase early morning breakout signals, especially in the technology sector.
We are in a post-OPEX chop environment. It's characterized by classic compression before a major expansion.
The required discipline today is to focus on range-bound scalps if you have to allocate capital. But primarily, you wait for the true earnings-driven trend to establish itself.
Tying all these data points together for this session today, the institutional perspective is that the market is a tightly coiled spring.
The surface-level futures look bright green, but the foundation is built on geopolitical anxiety, sticky bond yields, and heavy dollar dilution.
The mandate is clear. Do not fight the bond market. Keep a very close eye on that 4.59% resistance line on the 10-year yield.
If that breaks higher, the gravitational pull on equity valuations gets significantly heavier. The institutional flow has already moved.
They are abandoning the overcrowded tech bunker. They're locking in capital with operational efficiency, aggressive buybacks, and hard assets.
They are demanding mathematical proof of earnings, not speculative promises, which leaves you with one final forward-looking dynamic to calculate.
Our sources explicitly highlight that this current market compression is happening in the shadow of massive mega-cap earnings. Giants like Alphabet and Tesla are scheduled to drop their reports later this week.
If everyday retail investors are aggressively buying the tech dip this morning, assuming it is the safest place to hide,
while massive institutional funds have already quietly slipped out the back door into value and energy.
What happens when those massive tech earnings finally hit the wire? If those numbers fail to absolutely shatter Wall Street's expectations and that tightly coiled spring violently snaps, who's going to be caught holding the bag?
The trap is set.
Watch the yields, respect the low-volume nodes, and execute with discipline today.